worked hard, saved over $5 million, and now you're wondering, is it enough to retire early and not have to cut back on spending, or should you just keep working just a few more years? So in this video, I'm going to go through another case study of a couple who did an amazing job saving and investing. In fact, they hit some home runs, but while they were great at accumulating wealth, they were now concerned with how to make sure it lasts. So we're going to go through what they did right, the risks they might face if they do retire early and how to mitigate them, and then what you could take away from their case study to help secure your own retirement. But let's take a step back and understand where they're at today and what they did right. And you want to understand this because sometimes I see people and they hit a retirement portfolio target and they're like, hey, we're here, we're ready, I hit my number. And sometimes they think they're ready only to realize that it's one thing having a dollar amount saved, but it really makes a huge difference whether that's pre-tax, whether it's tax-free, whether it's taxable, and also how is that money invested. So let's meet Michael and Carla, both age 56, and these are not real names, of course. But what I want to start is look at their balance sheet. That way you can see overall their financial picture and what sort of accounts they do have in place for income and how they are invested. So I'm going to use round and general numbers here, of course, but if we break things down by account type, they have pre-tax accounts, so 401ks of approximately $2.4 million combined. They have $2.6 million in employer stocks. Now, these are both tech stocks. They also have another $150,000 just built up in cash as they were kind of preparing and getting closer to retirement. And then the other assets that are part of their balance sheet, but of course you're not taking income from your home, and their home is valued around $2 million. The only liability they have is going to be their mortgage, which has around $300,000 left on it. And as far as other income sources, there's no pension, real estate. The only other income source that they can expect other than the portfolio is going to be Social Security. And I really like that they had a good mix between pre-tax and also taxable accounts. Really, I see as a green flag, especially for someone that wants to retire early, is having that taxable account because it does just give you a little bit more flexibility. But what I noticed, not just with them, but with a lot of people in tech, is they're able to build a significant amount of their wealth just by holding on to their company's stock. But if you're watching this and you're probably asking, when should I be concerned having this much concentration and when shouldn't I be? And the answer is pretty simple. If that stock drops 30 to 40%, can you afford to dramatically cut your expenses? Because you probably don't want to sell that stock as it's trending downward. While you're working, maybe that caused a little bit of anxiety, but again, you weren't reliant on that stock for income. You might have actually been someone who bought more of that stock during the downturn. But for someone like Michael and Carla, the answer was pretty easy. They could easily make some adjustments and cut back in retirement, but they've seen fluctuations in that stock, and they knew that retirement was not a time to put all their eggs in that one single stock basket. So this was one of the biggest risks in their plan that we had to start to deal with first. Now, I don't have the time to get into all the details of their specific diversified portfolio, but let's talk about a useful framework to think about on how to get diversified. I mean, this could also apply to someone who is 100% equities right now, and maybe you're trying to figure out, hey, when do I start dialing back risk and maybe start to own some more conservative investments? So they could diversify, but wouldn't that mean getting hit with a huge tax burden? Now, taxes obviously are going to be a huge factor, but what if there was something bigger? What if there's a bigger risk? And that is the risk of this stock going down significantly at the start of retirement when they're going to be spending the most. And that can lead to permanent loss of capital. They call this sequence of returns risk. Now, that type of risk for some people is way bigger of a risk than just having to pay some taxes on your gains. Now, if you're someone where, hey, maybe this amount of concentration won't really hurt your financial plan, it may set you back temporarily, that might be a whole different story. If one downturn won't prevent you from hitting your goals, that's when I say, okay, maybe maintain a portion if you really believe in that company stock. But what you can do is you can go in and you can strategically sell specific shares. Now, typically stocks have different tax lots. Once they meet that certain long-term capital gain threshold, that's when you get that more favorable tax rate. And typically that's when we need to decide if we sell those longer term held stocks today. And when you understand that, then you can understand, hey, how much can we target in capital gains and how much of that stock do you want to sell all at once or maybe do it over a multi-year strategy. So in general, if you're someone who is like Michael and Carla and you're about to retire early, you need to understand the risk trade-off between taxes as well as diversification. The same thing can apply if you are 100% stocks right now. Maybe you can diversify now and the stock market may just continue to go up and you pay some taxes, or it could go the opposite way where you didn't diversify and now you're forced to sell stocks while dropping. So for them, the true risk is not necessarily taxes, but the permanent loss of capital of those individual stock positions. And we know that on average, a majority of stocks underperform the market. So the more you have in concentrated stock, the more risk you have in a downturn. But the good news is that in 2024, at least in the tech sector, a lot of stocks are performing well. Maybe your stock is performing well. So if you are nearing retirement, maybe it's a time to start planning out a potential diversification strategy if this is something that applies to you. But we can nail this diversification strategy and we still aren't done yet, because even a diversified portfolio has risk, especially if you overspend. So how can Michael and Carla know if they can actually make their money last based on what they want to spend? Now for them, they want to spend about $23,000 per month net after tax. And they know that their baseline expenses, or just living comfortably expenses, are about $15,000 per month, so about $180,000 per year. But on top of that, there are some other expenses we know that will eventually go away. These are what we call variable expenses, one being their mortgage, principal and interest, and then another $30,000 per year that they want to set aside for travel. And then also, of course, health insurance premiums. Like, you're retiring before Medicare, so we have to factor how that spending will go within their plan. So what we did was we put it all together to see what it looks like visually when we run some of these projections over the course of their lifetimes. Now, as you can see, there's a big yellow gap here. Now, this yellow gap is where they're going to be fully dependent on portfolio withdrawals. And you'll notice that it sort of ramps up in this little staircase fashion and then drops one by one. So what is happening here? Well, it's something that is really important to understand when you're planning out retirement. These drops are, in fact, those variable expenses I showed you earlier that will eventually go away. Now, high health insurance premiums, a home mortgage, these vacations that they want to take earlier on are not going to be going on constantly for the rest of their lives. And secondly, you'll notice this little wave here. Now, what is this wave? Well, retirement research shows that spending does not necessarily adjust for inflation on a straight line. It actually looks more like this, where you see spending is more earlier on, it starts to slow down and then ramps up way down the line when health starts to change. And by shifting some of your spending earlier on and planning for that way, and then spending less later on, it will help you avoid that regret zone of not spending enough when you had your health. This is what they call the retirement spending smile, or the go-go, the slow-go, and the no-go years. So factoring all this in when it comes to big picture of what you're spending, factoring in taxes, inflation, your investment returns, really this can start to give you that confidence that, hey, maybe you are on the right track. And Mike and Carla will see how this plays out for them. And what we know is that, okay, you can run this, but we're not quite done yet, because this picture is just the ideal trajectory of retirement spending. $23,000 per month in retirement spending, following the smile, having diversification plan. But we still need to have a game plan for when markets go down. I mean, over the long term, I think the S&P 500, for example, has averaged around 10%, but it can change year to year, right? For example, in 2022, the market was down around 18%, whereas in 2023, the market was up 20+%. And in 2024, at least year to date, the market is up nearly 26%. So do we continue to spend the same amount of money when the market is dropping pretty significantly? Now, the key when it comes to withdrawing money for retirement is not being overly conservative and just living off dividends or just not spending enough in general. You can read online, there are millions of articles on what people believe to be a safe withdrawal rate. The most common one people focus on, of course, is the 4% rule. I've also seen people focus on 3% as a more realistic early retirement number because it's more conservative, but they're focused on the wrong thing. They're focused on withdrawal rates and probability of success, which we could talk about more in a second, but let me show you just an illustration of why I don't get so attached to withdrawal rates. Now, Income Lab, which is a retirement research software, shows that for a diversified portfolio, at least historically, sustainable withdrawal rates are rarely below 5%. In fact, the only time it would dip below 5% in this illustration was be during the 60s, which was one of the worst times to retire historically. I understand that history is hindsight, right? But we don't know if you're going to retire in an environment like the late 80s type of retirement where you could have spent a lot more money because the market started to trend really well, or if you retire in a 60s type market where you really had to be conservative with your spending. And the key here that I will continue to make the case for is to be able to adjust your spending rather than just taking the same amount regardless of markets, regardless of what's going on. And these small adjustments, what I'll show you, might not seem like a big deal, but they can make a massive impact due to the nature of compounding. You know, when you're younger and you're talking about investing or even telling your kids or grandkids about investing, you just talk about taking a little bit each month or a little bit each year and taking advantage of compound interest over the long term. Now, when markets are going downward, this is sort of like reverse dollar cost averaging, and it can go a long way, just these small adjustments in terms of reducing risk. So for Michael and Carla, let's talk about how we can start to factor that into their spending when we're accounting for longevity, their tax situation, understanding that, hey, we're going to withdraw a little bit more earlier on, and rather than treating Social Security as a bonus, it's going to start to replace some of that portfolio income. So let's look at this and let's model out how we can use this. And we use what's called the risk-based guardrail system. What we could do is put it all together and establish those upper and lower guardrails to help keep their spending on track, and then we can just monitor it on a monthly basis so we can make any sort of necessary adjustments that they may need to make throughout their retirement. So right now, based on their portfolio balance at retirement, which is the dotted line here of around $5 billion, we set that initial monthly spending before taxes of about $24,000, just kind of rounded here, and we monitor this every month. Just say, for example, if their portfolio hits this lower guardrail right here, that's when we know we need to drop their income by about 5% to help lower risk, and it would essentially reset the guardrails. But also you get the upside of spending more when the markets do well, and also inflation adjustments. That way you don't shortchange yourself. Now you might be asking, how do you precisely know where to set these guardrails? This is a little bit more of a complex calculation using software, and there's a lot that goes into it. But if you're someone that wants a lower probability of having to adjust your income, then start by spending less. And if you're someone that is okay with changing your income and really have a lot of room for when it comes to cutting travel or some of these other variable expenses, then start to spend a little bit more aggressively. Ultimately, you're the one that's in the driver's seat in terms of, hey, what sort of a risk in terms of income adjustments are you willing to take? And all these details are really important for someone like Michael and Carla because there are a lot more variables and more complexity to account for when you retire for this long of a retirement period. But let's go to the last portion here of their plan that's going to probably cause you to have to kind of have a mindset shift. Now, there's a very common approach to retirement spending that is, in my opinion, is not as optimal in terms of when you begin withdrawing money or if you're in striking distance of retirement. It is what they call probability of success. And many of you are probably familiar, but what this is essentially running your plan spending through thousands of simulations to see what percentage of the time your retirement succeeds or fails. Now, the way this works is if you run it and you have a 90% probability of success, you start to get in that green zone where you start to feel pretty good about yourself. And then maybe down to 76%, you're like, maybe it's a C+. And then if you're someone that gets a 50%, you're probably feeling that, hey, maybe this is quite risky. The problem is that in all likelihood, a 50% probability of success is actually the most likely amount you can spend. And that could be pretty shocking to hear. Now, naturally, that feels kind of like a coin flip. Naturally, most people love the number 100%, but where does that leave you in terms of retirement? By having a 100% probability of success, that can leave you in the regret zone because you have a 100% likelihood of underspending. This is saying in 100% of scenarios you run, you could have spent more. In other words, probability of success when it comes to retirement spending doesn't mean what we really think it means. It doesn't mean, wow, I'm really using my resources well. What 100% probability of success means in reality is that I'm going to probably leave a lot of money left over when I die. And most people do not want that. So here's the difference that I want you to think about, and you'll understand this when we finally test their plan. Now, let's shift that mindset from probability of success to probability of adjustment, meaning what sort of changes can we expect to make based on this level of spending. And for Michael and Carla, when we run and test this plan through thousands of historical simulations, we could see that in 93% of scenarios, they were able to spend more. In only 7% of scenarios, they would need to decrease their spending to avoid risk. And within the simulation, there's an average increase of 5% every 2 years and an average decrease of 5% every 9 years. So what I often see in practice is a sense of relief, knowing that failure is just not an option. Instead, I encourage you to view retirement when it comes to evaluating, hey, what sort of risk am I willing to take? What this is essentially saying is that when risk increases in the plan, then downward adjustments to spending will be needed. And then on the other side, if risk declines, which they're based on their spending levels, seems to be more likely, spending can safely increase. Now, your takeaway is that retirement really is not about hitting a single number. It's about building a plan that adapts to life's uncertainties. And for Michael and Carla, it wasn't just having a certain amount saved, it's having the confidence in understanding how to manage any sort of changes like concentrated stock, market downturns, changing expenses. And by focusing on probability of adjustment instead of probability of success, you can really start to spend confidently, knowing that your retirement is not pass fail, and that means you can use the resources you've worked super hard for. A lot of people have the wrong idea of how to invest for early retirement. Some people are on the opposite end of the spectrum where they aren't too conservative, they're actually way too aggressive. But when it comes to early retirement, asset allocation is really a big deal as far as helping shape how you start spending money, how you make your money last. Some people can be way too aggressive, taking on huge risks, and some people way too conservative, which means they're not going to spend enough. Their portfolio might not keep up with inflation. So I made a video on how to build your portfolio for early retirement success. You can watch that by clicking right here. Again, this is Matt Calcagno. I'm a certified financial planner and advisor with 1 Degree Advisors. If you'd like to talk to me or someone on my team about your financial plan, you can click the link in the description and we would love to talk with you. Thanks for watching and have a good one.